How are you, folks? The Enzo Di Costanzo podcast, and we're going to continue our discussion for the final exam for spring 2019. We left off last time here, a staff review of the economic situation, and what I'll do, I'll just clear out right there. Now, again, you see what they're saying here. It says information available as of the mid-December meeting. Again, we've had a January meeting, we've had a March meeting, and there'll be a May one. So we'll see how much. And actually, as I get more back into doing this again, monitoring these meetings, we'll have regular of all 8 of them, during the year. And it says now, as of these guys certainly know, sort of the intermediary accumulation of these numbers. It says United States real gross domestic product. It said it was increasing at a modest pace in the fourth quarter of 2022 after expanding strongly in the third quarter. Again, we're not building the whole model in these classes, but we can click on output, and I have these models, monitoring them and constantly updating them. So here we are. Okay, and again, this is the nominal one. Make this a little bit bigger. Yesterday we were messing with everything. Oops, not like that. We were trying to find some graphs yesterday, so we sort of shrunk everything somehow. But this is nominal GDP, dollar changes. This is the real one. Again, these are annualized amounts. It's not 20 trillion every quarter. It's if the year behaved as that quarter, you have 20 trillion for the year. So it's an annualized number. So certainly you can see there's a positive delta right there. You could go quarter over quarter. So these are deflators. The deflators are another inflation measure. So you can see, obviously, we were pretty high, and then our inflation's declined, sizable. Again, this is another version of deflation. So if you look at how we look at these, you take these indices. This is the ratio, is what this is. This is the ratio of the nominal to the real. Okay, and then multiply that by 100, and you get that rate. That's the ratio of the nominal to real. That's the implicit price deflated, which we really don't teach this in these courses because it's just another complicated thing to go over. But it's the ratio that's good enough. And this 3.5%, this is just the annualized percentage change, and this is published in the press releases from the Department of Commerce that's out there. Okay, and this is actually there's a couple of them here. So I have two. I write the personal consumption. This is quarter over quarter percent change, and this is the personal consumption expenditure version of that. Okay, so it's the overall output. You can say production, and then you can say consumption if you want to. And they're pretty. You can see the numbers are relatively similar to one another. The 3.5 and 3.2. And these are percentage changes from the preceding quarters, and these are annualized. So again, we're down a bit. And let's see what this says. It says at a modest pace after expanding strongly. Well, I don't know if it expanded strongly in the third quarter, but maybe consumption. You could maybe say consumption did or something like that. So this is from, where is this from? Yeah, actually that's the nominal change, the bottom one, and this one. This is the real. Which is right there. Okay, so you have I guess obviously it's appreciating, but appreciating at a reduced rate. And now, unfortunately, Q1 and Q2, you had negative changes in real gross domestic product. Okay, this is contributions, and this is level change. These are the price indices, and this is again another way to measure inflation. You can see we're pretty high, and they were lower in Q3 and Q4. And actually, these come from the price indices, which are here. And this is the year-over-year change, which we like that one a little bit better. And this is the quarter-over-quarter change. Again, I'm just making you guys aware that you have to create this stuff. And this is from a quarter a year ago, is what this is. Yeah, that's the real change right there from a quarter ago. The same quarter a year ago. Yeah. This is Q4 over Q4 is what that is, but based on the current year and the previous year. Okay, you have that one. These are price indices for major product types, and then yeah, and actually these are the this is the 2, 3, 4. Yeah, we've seen this previously. Again, this is another inflation measure. We've previously dealt with this, and these are the year-over-year changes. So again, it's a different press releases. I'm trying to validate the numbers. Okay, but like I said, but in terms of how this is doing, that's contribution, which I don't spend too much time on. This is preceding period. That's the deflator, and yeah, this is preceding period there, and then we have yeah, I don't think they don't do the year to year. It looks like with this with the real. This is preceding period, and this is deflator, the price deflator. I mean, and you could determine the year over year number. Yeah, that's just the same. Yeah, that's just quarter to quarter change. We could do changes from a year ago. That's another way to do it. This is contributions. It's not going to be that preceding period. That's price indices, and this is from fourth quarter over fourth quarter. Oh, here it is from a year ago. Yeah, these are the year ago. So again, not as again. I can't sit there and say, well, the second quarter was much different than Q3, but they say that here. So strongly, well, I don't know if that's real. I wouldn't call that strong, but okay, that's the price index. Q1 and Q2 were big moves, but I wouldn't say quarter over quarter. Yeah, 3 and 4, I wouldn't say we're too different, but okay, they're saying that. And again, we don't. I didn't spend a lot of time going through the definition of this and all that, but let's see if do we have definitions here? Nominal versus real. See if if I put definitions someplace for this. Current dollars, aggregate output. It's that. Yeah. This is not this is from the textbook. I think we went to scope and methods. Yeah, here's real GDP. It's an inflation adjusted measure that reflects the value of all goods and services produced by an economy in a given year, based on base year prices, and is often referred to in constant GDP or inflation corrected GDP or constant GDP. It's a macroeconomic statistic that measures the value of all goods and services produced in an economy in a specific period adjusted for inflation. And there's also what the CPI is. There's all sorts of that stuff floating around here. So we have a lot of these definitions that we need. What macroeconomics is, what financial modeling is, monetary policy, PEA models. Yeah, I didn't continue. I broke these out into other places. Here we go. GDP, inflation, CPI, financial markets. So we have all that stuff for you guys. Again, that was just a sentence. That says labor market conditions eased somewhat over October, November, but remain quite tight. So let's look at some of the labor market numbers. And again, I always recommend that you guys, even though I didn't necessarily. So now again, you can look at the December. I updated the January numbers, but so they're only going to talk about December, November, and numbers like that. So let's say copy here. Okay, so we're looking at and actually the number that's really reported is the non-farm, which is down the turnpike here a bit. There we go. This is what's really reported a lot. And I went back to '08 with this. So, and actually looking at this, so that is, but yeah, okay. So we were looking at some of these probably in some other video that we outline these numbers. So if we're looking here, what do these guys say? These guys said conditions ease somewhat, but still remain. So what it remained quite tight. What does all that mean? So October, so the delta declined. It went from 350 to 324 to 290 to 260. Okay, and then it bumped up, but they're not. This meeting was in December, so they didn't know what these. They may have had a preliminary, but they didn't know what these numbers were for January. So yeah, a tight means not hiring as many people. So if you look at this, you have a declining delta, is what you have there, right? So if you look at this is just the month over month change. This is the year over year change is going down. The percentages are going down. Or the annual percentage is going down. Okay, so you have a decline in the number of people that are being added to the labor force. That's really what I mean. Like, a tight labor market and remain quite tight and ease somewhat. I mean, what does that stuff mean? You have to define your delta. And again, so when you have the speak, the central bank speak is that way. But you have to break it down to the math. Is that delta getting bigger or smaller? That's really what you care about. Consumer price inflation or consumer price inflation. We just looked at an example in the output, but the 12% change in the index of personal consumption stepped down in October, but continued to be elevated. Okay, so this is their favorite, the U.S. Central Bank's favorite way to measure inflation, and we just cross paths with that in the output here. So we had the monthly; these are quarterly numbers here. Yeah, these are the monthly. Those are annual numbers here. This is annual. So we're here with this. This is quarterly GDP. Yeah, the 2, 3, 4. You can go. Yeah, you have a quarterly measure here. Yeah, change from a year ago. This is real gross domestic product percentage change. So I suppose that this is based on the indices. Yeah, this is based on the indices, is what this is. Yeah, this is based on the price change here. And what we say this was? It said step down October, but continue to be elevated. All right. Well, yeah, down a bit, but outright 6%, which we like to see this number 2 or 3%, and it's 6 here. And also, if you go to the PCE, which we had the other day, these are the annual numbers, quarterly numbers, monthly. Here's your monthly numbers 286. Sorry about that. That's someone in class said that's an annoying noise. It's annoying for me too. Sorry about that. I know. I don't appreciate it myself. So, and actually, this copy this here. Because just while we're doing this, I'm just going to adjust here. When you have a Bloomberg terminal, it sort of does this all automatically, but you're seeing sort of the difference. But if you're good with Excel, you can do it yourself, and I like to think that you understand it better by having to constantly update what's going on here. I hope that's something that you sort of consider here. And again, there's going to be statistics in the work that you do. There's not going to be anything, you're not going to do much for a living that isn't a number-based pursuit, sports included. So, right, as if you look at the analytics, how much that's changed, it's changed a lot from when I was a kid. It was hits, runs, ERA. That was about it. That's about all you cared about. And now I still don't know what wins after replacement is. There's a pitch clock now, like it's basketball. There's a pitch clock, like the shot clock in the NCAA and basketball and things of that nature. So it's to me it's becoming less and less recognizable. The sport of, as much as I love it, it's becoming less and less recognizable to me. So we're doing. Yeah, these are the year-over-year changes. So yeah, it's still elevated, but it's not as elevated as October or November. We have 5.3. Yeah, the 12% change. They didn't give the number. It said it stepped down. Yeah, it did. It stepped down from 6.3 to 6.1 and 5.7 and 5.3. Okay. But again, we've discussed personal consumption expenditure. It's durable goods, non-durable goods, the services that people buy. And yeah, I think we just discussed this. The total non-farm payroll employment posted solid gains October, November. Again, let's take a peek at that. And again, when you have all these set up like this, so October, November here, yeah, I mean, the gains aren't as large. That were slower than the average seen in the earlier parts of the year. Let's see. Yeah. I mean, if you look at so you look at these month-over-month changes, right? You were, at 0.27, 0.24, now you're 0.21, 0.19, 0.23. So you're down from 0.27 and 0.6 and a quarter percent, pretty much a quarter, 0.2% or a fifth of a percent. And these are the deltas. Okay, and you're really, it's the numbers are down. I just said that previously. So and again, this is non-farm, which seems to be the favorite one. And you can look across at employed persons. You can look at several different measures of this. It says the unemployment rate moved up 0.2 of a percentage point to 3.7 October and remained at that rate for November. Okay, so now we're looking at employment rates and seeing how this has changed. And again, going to our own personally set up Bloomberg terminals that we pretty much have here. I have this in a couple places. I computed it myself, which I'm always happy to do. So we're looking at here. Looking right there. Yeah, these numbers should be close. I'm looking at the numbers. They are pretty close. 5, 3, 7. What's reported and what we're looking at here. So we're looking here, right, at this. And we're looking here at that. And what does this thing say about it? It says 3.7 in October. Yeah, 3.7 October, 3.7 October. Good. And remain there. I don't know, 3.6, close, 3.6, 3.65. Close. Okay. Close, but not, not exactly, but close. So yeah, so we have that. We've looked at that. It says unbalanced unemployment rate for African Americans. So I didn't break it down into further categories that are broken down here, but you can certainly look those up in the press release, and they're there for you guys to do that. Above the national measure. And it's now the next is labor force participation rate and employment to population ratio declined over the past 2 months. So again, we can look at this thing. Again, labor force participation rate, pretty steady. It says declined a bit. Yeah, well, yeah, a bit. Yeah, a bit is so that's participation rate and employment population ratio. Yeah. So here's employment population ratio. That's declined, and the participation rate nudged, a tenth of a percent down. Okay, which is what you have there. So, and again, looking at these, you can look up the definitions of these, but we worked through this for this one, the participation rate. This is going to be employed persons, unemployed persons divided by employed, unemployed, and not in the labor force. The ratio, the employment population ratio, and actually let's find where these come from. This is population. This is civilian labor force plus not in the labor force. I computed that number. And then what we have here is employment. Yeah. And also, like I said, we didn't necessarily peek at how employment was doing, but we should we should. So again, you're looking at these couple months here, and employment level. So here, October declined, November declined. It's a bigger umbrella. You can look up the definitions of this if you're in the military, incarcerated people, people who are self-employed. It goes into all of that. And actually, I might have those somewhere. Yeah, here's employed persons, 16 or over, civilian institutional population, very legal, that did not work, did any work at least 1 hour as a paid employee, worked in their own business, profession, or their own firm, or worked 15 hours as an unpaid worker, an enterprise operated by a member of the family. Very legal definitions of this stuff. What the unemployment rate is, what the labor force is. So the labor force participation. It's a civilian non-institutional population as a percentage, right? Labor force as a percentage of the civilian non-institutional population, and on and on and on. And you have all the definitions here. You can go to the labor statistics website, which is where I got these definitions, and feel free to look at them. Okay, so, but we're not, again, it's not, it's not a labor economics lecture, but just, we use those statistics a lot. Private sector job openings as measured by the open job and labor turnover survey moved back down in October, but remained high. So I didn't use that survey, but I did measure private sector job openings, and let's slide to that. Employment, which is here, employment level. Farm. Here's total private, which is here. And again, what are we looking at? We're looking at these couple months right there. So you had a lessening of an increase, but still an increase, but lessening of it. And what did this say? This said move back down, but remained high. Okay, yeah, well, move back down. It didn't increase as much. I wouldn't say move back down, but it didn't. And then it popped up. Yeah, so these are all increases. These. So again, if you just look at the year here, what does this look like? Insert, scatter right there. Yeah, you're pretty much continually increasing the whole way. Okay, which is right there. That's private sector. And again, maybe it's actually looking back at this, maybe it's useful for future. I'm not going to do it for this run through, but maybe it's useful to do just a year of data, because that's they seem to be talking about it in that manner, right? Just a year of data. And then it says nominal wage growth. It says continue to be elevated, remain above the pace judged to be consistent with the Federal Market Committee's 2% inflation objective, which we look at often here. It says these things, the average hourly earnings rose 5.1% in the 12 months ending November. Close to the pace recorded in employment cost index of hourly compensation over the 12 months ending in September. Compensation per hour in the business sector rose 4% over the 4 quarters ending in the third quarter, but the reported increase likely underestimated the true pace of increase, as the lowest second quarter employment data from the quarterly census employment did not incorporate the CPH measure. Okay, all of that. Average hourly earnings. Let's check. We have that. Okay, let's check that out. That's the government employment level, which doesn't change a lot. On form, here's average hourly earnings. Okay. Yeah, there's the 5%. So I think we looked at this previously. Over the 12 months, average hourly earnings right there. So yeah, so from a year ago, right? This is from the November change 5, and the October change also practically 5. So yeah, looking at these two, right? It looks like, we have those numbers dialed in. We computed that correctly. It says 5.1, but again, these get updated, and this is ending in November. That's the November number. So yeah, 5 or 4.99. And then it says the compensation rose 4%. So I didn't use the survey that they're talking about here, or I didn't track this particular number because this is enough. I didn't track that particular number down. Okay, now we have some real checking to do here. Um, this is consumer price index. So this is the total consumption, personal consumption expenditure, uh, inflation. So this is the months ending in October, right? You have the October number that you're looking at. You have the September figure that you're looking at. Then you have a core version of this, which we're going to take a look at. This is personal consumption expenditure price inflation. Okay, that would be this. Yeah. So what are we talking about? October, yeah, 6%. Yeah, there's your 6%. And you had a 5. So eliminating energy and food prices, you had a 5% change ending in October. Whoops, I'm sorry. I can't spit that word out. Ending in October, right? And then down 0.2 from the September reading. I don't know if it's 0.2, but it's a tenth of a percent. The other one is about 0.2%. This now it's 0.3, but okay. So but yeah, so it's the core PCE price inflation and the consumer price, personal consumption expenditure price inflation. And again, this is the price index for person. Again, these are the year-over-year measures as we previously mentioned here. And again, the math on this is simply these indices are published and computed by the Department of Commerce, and they take the yearly numbers. And obviously, the data you couldn't do it, yourself. You have to use the government numbers unless you're going to stand outside of Best Buy for the rest of your life and say, "What'd you buy and how much did you pay for it?" Which is about what that is, but it's done obviously on a wholesale version. The trimmed mean measure of 12-month PC and constructed by the Federal Reserve Bank of Dallas remained at 4.7 October. So they're playing statistical games with this. The November 12-month change in CPI stepped down to 7.1%. And the core, yeah, so this is a CPI. Yeah, these are the CPI now. So let's look at these. This is CPI, core CPI. And you'll hear, I just heard a talk from Dr. Al Areen from the Queen's College, not the one I went to, but the Queen's College in the United Kingdom. And he was talking about how important the core CPI inflation was, and the overall, the overall CPI inflation measures were. So let's check those out for November. All right, let's see what those November ones look like. So this is from labor statistics now. Okay, here's again CPI. We discussed this I'm sure in previous videos. Yeah, the November one is 7.1, and the core one was about 6. Yeah, so we have both of those. Okay, and again, that's just the year-over-year change is all this is. So we have those computed, and again, previous videos we go through how to construct these, and um, this is the percentage change, the month-over-month percentage change, annualized percentage change, the year-over-year percentage change. We've repeated that in a number of lectures. Yeah, I don't really go into the producer price index too much, but I probably should. But I didn't look at that. Where is that? Just as we're here, we can just take a quick look. Databases. Electric power distribution. So you can see petroleum, lubricating, oil and grease manufacturing, industrial gas manufacturing, chemical manufacturing, fruit and vegetable canning, electric power distribution. So their costs: aluminum sheet, plate, foil manufacturing, iron steel mills manufacturing. Okay. So these might be the headline numbers, apparently, final demand, motor vehicles, final demand list food and energy. Okay, no, we have these. Okay, this is commodity data. So yeah, so there's now I can see why I didn't venture into this too much. You have to sort of pick. This is final demand, seasonally adjusted. This is goods, foods, energy. We'll start maybe working with these a bit. Um, in future future classes. Petroleum, industrial gas manufacturing. Let's see what are these indices? Not seasonally adjusted. Industrial gas manufacturing. Yeah, so these yes, so it's the PPI for these industries, and I guess we have to have a top line one for demand. All right, so this breaks it up into industries, and the other one breaks it up into demands. Okay, so for the future, you go to the labor statistics website, you can take a look at that. Yeah, it says a preliminary estimate of the staff's common inflation expectation index, which combines information from many indicators of inflation expectations and inflation compensation, edged down in the fourth quarter, but continue to be above pre-pandemic levels. Okay. All right. Let's have one, two, three paragraphs to go. Okay. And it says after expanding at a moderate pace in the third quarter, the real personal consumption expenditure growth appeared to have picked up in the fourth quarter. So again, these guys probably had little bit of an advanced reading on that. So let's check out our quarterly PCE numbers just to take a look at them. So we have the quarterly. This is personal consumption expenditure. We looked at the monthly numbers, which are here. Here's the quarterly numbers. And what do we have here? This is percent change from preceding periods. So what is this? Real PCE growth. Okay. Yeah, so we do have the fourth quarter numbers finally. And this is the dollar change from the preceding quarter, percentage change from the preceding quarter. And then we have hopefully the year over year. My major part type. Yeah, this is here's the year ago numbers, which are generally what we look at here. Okay, so you were 2.2, 1.9. Now this appears that this is notoriously these numbers move around a lot. The personal consumption expenditure numbers take a couple periods, quarters, months to settle. But at the time, they said it appeared to have picked up in the fourth quarter. It appeared to have picked up. Well, not by this, it did. Not over the year-over-year numbers. And let's see, this is preceding period. Even from the preceding period, it didn't seem to pick up too much. This is just preceding period. It's right there. That didn't pick up. Okay. And then what do we have here? This is okay. That's annualized. Okay. And this is not. This is just a quarter over quarter change, and that's it. It's still none of them picked. Okay, but maybe when they looked at them, these may have been expanding a bit, but it certainly didn't do better than the third quarter. From the third quarter to the second, it did better, and from the third quarter to the first quarter, it did better. But the fourth quarter relative to the third, second, and first did not do better. Or no, it did. No, it did better relative to the second and third, but not first and second, but not the third. Yeah. Okay, so like I said, but those are notorious to move around a bit. And then residential investment contracted sharply, business fixed investment contracted, equipment and tangible spending, non-residential structure. So that's from the output uh, model. This is nominal. This is real. And these are deflators. Yeah. So here, what you're looking at sort of down here, these numbers. And what did it say? It says, residential investment contracted sharply. Yeah, minus 26, minus 27. Okay, you had that contracting sharply. Business fixed investment seemed to be slowing. That one, that was negative. True. Okay. Equipment and intangible spending, not really a gain. It's a decline. That's a decline. Yeah. So that one didn't match up. And then non-residential, that overall number, mild increase. It said decline, but there was a mild increase. Manufacturing production increased only modestly in October. Available data pointed to a decline in November. A decrease in factory output would be consistent with recent readings from national and regional manufacturing surveys and showed declining new orders and drawdown in order back. Yeah, the new orders. I didn't study those. But I should study those. So I got to put that on the. Every time I do this, there's something else that I'm going to add to it. So forgive me for that. Then it says U.S. international trade deficit. So yeah, the international stuff. You could take the press release. I think it's from the Census Bureau, sort of the export import pressure. It's like 30 or 40 pages long. It's everything you'd want to know about those numbers, and it takes a really long time to hit that. But that's something you'd want to take a look at that. Let's see if we can quickly find an example of that. This is census export. I think it's census. Foreign trade. Yeah, it looks something like this. Yeah, the trade goods and services reports. Let's see. This might be there's an Excel yeah, I think it's the FT, the foreign trade 900. I think that's what it is. Yeah, and you can see the number of pages. It's 63 pages. I could do a course in this. You could really do an entire course in this material. And there's the export deficit, exports, imports, as of whatever time periods you're looking at here. It says since we're in the U.S. Bureau of Economic Analysis announced today, goods and services deficit was 70 billion in February, up 1.9 billion from 68 billion in January. So this is like our balance sheet of what we sent out. Okay, February exports are 251 billion. February imports were 321 billion into the country, and then it really breaks it down. I mean, really, really cuts it down into consumer goods, automotive, industrial supplies. Like I said, you could do a whole. This is another goal of mine, just over the years, to just do a nice version of this. And it says survey of current business. This might be something else. Yeah, again, this is another press release from our good friends at the Bureau of Economic Analysis. So you guys can look at that, and then it gives some definitions what goods are and all those kinds for imports, and it gives you sort of the structure of how this is all measured and the different places, Europe, and then commodities and price adjustments. But then there's the table. See, it's okay. You're up to whatever 20 pages or something. Yeah, here's the tables. There's a lot of tables, and we'll look at the first one here. So this is what we're exporting, and here's what that looks like. So, and this is in millions of dollars. So obviously for January to December, our total exports were about 2 trillion, because this is 600 million, 556 billion, then 2 trillion. So for 2021, for that year, we sent out 2.5 trillion, and then we bought from France and China and whatever 3.4 trillion. And then it breaks it down by the month and balances and all these other kinds of things. And you could go through this and get all the data. Now you wouldn't want to do this by hand. That's if you looked at the beginning of this, there's a spreadsheet version of this that you can download this. But this is so. But again, for people who are going to work internationally, you're going to really you'll be good friends with this. And then it does the 3-month moving average, which you could do this yourself. That you don't need an exhibit for that. By categories here, these guys do transport, travel, construction. It breaks it up into pieces. So as you're breaking this up, you can hopefully add up. Now this is services, okay, exports of services, not exports of goods. U.S. imports. So this is, yeah, this is U.S. exports by services, U.S. imports by services. And like I said, it breaks it down in every conceivable manner. Okay, and then adjustments, census basis, total balance of payments base, and the different statistical matters that this is working. But this is not something for the this is not something for someone just to flip through it. If you're going to work with this, you want to know all 63 pages. Why, what, how everything is computed, and then it really breaks it down. Food, total sense, foods, feeds, beverages, rice, meat, nuts, oilseed, bakery products, corn, fruit, vegetables, on and on and on. Natural gas, copper, leather, inorganic chemicals, plastics, civilian aircraft, probably cars, automotive parts, yeah, passenger cars, trucks, engines, body parts, chassis, tires, tubes, and it goes on. And like I said, it just goes through. But like I said, if you're going to work with the monthly change, you could do monthly changes as long as you have the data. You could do moving averages. You could do all that stuff, so you don't have to worry about too much. But again, I did not, because this video would go on forever if I expanded everything that was out there. But this is where you find it. It's from the census area. So the deficit widened in October. The real goods exports, and you could back that out. The deficit. That's just the we could even just flip to that right now. They're talking about October, right? They're talking about October. We can look that up. Trading goods and services. So we're in 22. We're up 23. Not there yet. October, and the total balance is, yeah, so it did move up, right? It was minus 72, now it's minus 77 billion from minus 72 billion. Okay, so it did, October did move up, and then it went down. And so the net numbers, and you're looking at this, the goods number, the services number, what was up, what was down. So certainly we're better lawyers, we're better service providers, but certainly when it comes to manufacturing, we're not as competitive. So the whole Trump dogma, or the whole Trump thought process, doctrine, the whole Trump doctrine, it sounds good in Ohio and Michigan and Pennsylvania. It sounds good in places like that, but that may not be. America's future is not going to be in manufacturing. It sounds good to say that, but you need a time machine to go back to the 50s. It says real goods exports fell, led by decline in industrial supplies. So you can see, so they went through this and picked out industrial supplies. I didn't comb through it like that, but real goods imports rose, driven by increases in imports of industrial supplies, which more than offset the decline in imports of capital goods and consumer goods. Exports of services increased in part as travel exports continued to recover, while imports of services were little. So, like I said, but you'd want to go through those initial pages and maybe the first couple tables and go through that. And then finally, we have the international, the foreign economic activity part of this, which is here. It grew at a moderate pace in the third quarter. And again, I didn't look up how Japan is doing, or Europe, or whatever it is, but it says, according to these guys, and again, but it's the same measures, it's the same output measures, what the consumer did, and oil exports and things of that nature. But again, you have to look up the specific countries and specific areas of the world that you're looking at, if you want Asia or the Eurozone or whatever it might be, South America. But it says more recent data pointed to weakening growth, weighed down by economic fallout in Russia's war against Ukraine. And we've seen that in a couple comments here. COVID-19 related slowdown in China, so they're still dealing with that. High inflation continued to contribute to a decline in real disposable income. So so again, their version of we looked at disposable income and how you get to that, rental income, wages and salaries, return of assets, all that, dividend income, interest income, farms, whatever, that all adds up to disposable income, transfer payments, whatever it might be. Together with disruptions in the energy supplies, depressed economic activity across Europe and China, authorities began to ease social restrictions, even as COVID cases surged, raising the prospect of significant disruptions to economic activity in the near term, but also faster reopenings. Weaker global demand and higher interest rates also weighed on activity in emerging markets. So again, weaker global demand, higher interest rates, cause a decline in economic activity in anywhere, but certainly in emerging markets. Despite tentative signs of easing in foreign headline inflation, core inflationary pressures remained elevated in many countries. In response to high inflation, many central banks further tightened monetary policy, albeit a slow pace. So in other words, a lot of central banks are increasing interest rates. A lot of central banks are pulling capital out of the banks, or selling treasuries, in other words, and taking the capital away from the commercial banks to lend out, basically. So, okay. Like I said, so again, we didn't specifically do, I mean, we have this lingering part here with the, which we still didn't work on this. I could have done it tonight, but but this shouldn't be too big of a deal. The dollar to euro exchange. I mean, if you just look at how this is put together, what you're going to have here, right here. I'm just telling you how to do it, right? You can get this data, St. Louis Fed, all right? This is dollars, and it says this is the US dollar price for €1. Okay. So if you look at this, obviously the euro was very strong here because it took a lot of our dollars. So the dollar was weaker here, and the euro was stronger because it took $1.23 to buy €1. Okay. And then as you go through this, the euro is cheaper, $1.16. That's a lot to go from 125 or 26 to 113 or 114 is a that's a strengthening dollar. The whole, looking at this stronger dollars. So again, as it costs less dollars to buy the euro, that means the dollar is stronger. And then it weakened a bit again. It's up to the 120s from 105, right? It's up to the 120. So the dollar's weakening. Again, it takes more of our dollars to buy the euro, 21. Dollar strengthening again in 22, too strong of a dollar. Because we buy a lot of foreign currency. Our dollar is really what that means. Looking over here, right, as you're looking through this, the euro version of this. So let's see, let's go where we have the 120s or so. 113. Yeah, so here the dollar bought, 0.86 euro. Now the dollar's buying, 0.9 euro, 0.97 euro. It's buying more than a euro, right? So you're going from, 0.86 or so up here. We know we got a weaker dollar right here. There are some that they're 0.7, 0.77 or some of these, right? Or something like that. Yeah, point almost here, right? 0.089. It's almost 0.79. That's almost 0.9. So the dollar's strengthening. So a stronger dollar means you're buying more of a foreign currency. That's about, and these are just the deltas and the percentages. That's all that is. Like I said, you guys, we've done so much of this. You can just go to the Fed site and do that yourself. I don't need to. I feel like I don't need to repeat myself again and how to make another table, another one of these analytical tables here. So, okay, all right. So you have your 10th video. Keep reviewing a lot of this material, and the Enzo Di Costanzo podcast on Easter Day. Happy Easter, and we'll see you next time. Thank you.